So when it comes to cash dividend or any kind of dividend, there is actually, so how does a dividend is declared? Who declares the dividend? Basically, board of directors, right? So board of directors will declare the dividends on an annual general meeting, AGM. We call it as AGM, annual general meeting. At that day, when the board of directors declare a dividend, from that point, it becomes a liability for the company. Until that date, if the directors didn't declare any dividend, then there is no liability for dividend. And none of the shareholders can ask for dividend also. The board of directors declare dividend, then they have the right on dividend. So there's a declaration date. So when you talk about dividends, for example, you have some shares of Google or Facebook, anything. What happens for these shares in the stock market? Every day, every second, the trading is happening. So today there may be 10,000 shareholders. After tomorrow, maybe next 10,000 shareholders, maybe different people. So who will receive this dividend? Okay, who will receive the dividend? Because today when the company declared the dividend, there were around 10,000 people who were as shareholders. Maybe this dividend is not paid today, maybe after 3 months. So there should be a cutoff for the taking of list. That is called the record date. Okay, so that day when the dividend is declared, they will say, okay, this is the cutoff date. Whoever want to get the dividend should hold the shares till that date. For example, on January 15th, company declares the dividend. So that's the declaration date. And the board of directors say, okay, we will pay the dividend after 3 months. Okay, but we will take the list of the shareholders on February 15th. So whoever want to get the dividend should not sell their shares till February 15th. Once the list is removed, they can sell the shares. So that
when all the stocks after that date, I will not receive it.
Yeah, after February 15th you brought, you will not receive. If you brought even on February 15th or February 14th, you will get the dividend. Okay, so that is the importance of the record date. Clear? Okay, then just a second. Yep. So what we are talking about? So declaration date, record date. So on the record date, whoever names are there, they will be paid the dividend. Okay, they will get the dividend on the payment date. Now, so the most common form of dividend is the cash dividend. An entity declares a dividend based on a dollar amount per share. Okay, each shareholder receives cash as the form of distribution. On the declaration date, the board of directors formally approves a dividend. A declaration of a dividend decreases the retained earnings. Okay, so from where we will give the dividend? From the retained earnings. So when the board of directors declare the dividend in the board meeting, at the same time, what the accountants have to do? They have to pass a journal entry, retained earnings account up to dividend payable, whatever the amount. So this entry comes the date. Okay, then what if you don't have money in the retained earnings? Can you still pay dividend? No, you can't pay. If it will be? Yes. For example, if you don't have a retained earnings balance, that means you don't have enough profit to declare dividend, then company cannot declare dividend. Okay. But in some states in US, they allow declaring dividend. But from where you will give? You will take from the capital. Because in the equity side, what you have? Opening capital plus additional paid capital plus return earnings. If the return earnings is 0 and still you want to minus something from there, then from where it will go? From the capital. So we call it as repaying the capital, also drawing from the capital. But this is not allowed in some countries, some states. But still that happens also. Okay, just for general knowledge, not from the text.
Capital.
Yeah. Don't worry about this. This is for general knowledge. Yeah, but some companies may be in loss. Okay, such companies also they want to pay dividend, they can do.
if they are not as a should, they could make a dividend?
It's not necessary. Only the board of directors declare, then only it is becoming liability. So until if it's for 10 years or 100 years, the company decides not to give dividend, they don't need to give dividend. No shareholders can ask for dividend.
Even if they are making profit.
Even if they are making profit for the last 100 years, no one can ask for dividend. Only when what they can do, for example, if you four are the shareholders of my company, okay, and I am the board of directors, I'm not a shareholder, I run the company, and for the last 100 years we are making profit, and I'm not giving you dividend. What power is vested upon you is that, okay, in the election. So who decides the board of directors? Who elects the board of directors? You guys.
Yeah.
You can bring someone else and vote for him and remove me and ask him to give dividend. This is what your power is. Okay. Okay. Now,
Excuse
so
me, sir.
yes, come on. Ask.
Yeah, just one thing. The record date,
Yeah.
it will be declared on the declaration date itself?
Yeah, most probably.
Most probably. Okay.
Okay. And the record doesn't have any impact on the accounts also, that we will read here. Okay. All holders of the stock on the record date are legally entitled to receive the dividend. There is no impact in the firm's accounting equation on the record date. And the payment date is the date on which the dividend is paid. Clear? Yeah. Now, for example, yeah, on September 12, a company's board of directors declares $3 per share dividend to be paid on October 15th. Declared on September 12th, okay, they said we will pay on October 15th to all the holders of common stock. On the date of declaration, 40,000 shares of common stock were outstanding. So how much is the dividend? So 40,000 into $3, so 120,000. So dividend payable and return earnings less. So your journal entry is return earnings account debtor 120,000 to credit side dividend payable 120,000. Okay, and on the payment date, what will be your entry? Dividend payable account debtor 120,000 to cash. You're paying. Got it?
Here the declaration date and record date are same, right?
No. Here, see, there is no accounting entry on the record date. That's why we don't have any transaction recording. It's just the back end. The accounts people collect the holders list to make the payment.
Okay.
Got it?
But here in the example, it is showing that declaration date they are passing on the declaration date they are passing a journal entry.
Yes, on the declaration date they should pass the journal entry. Why? Because on the declaration date itself, it becomes a liability. We are not paying it now. The journal entry. Sorry, this property.
On record date, there is no impact on the books of accounts. Yeah.
There is no impact. There is no impact. Only record date is important because you need to get data of who should be paid, who should get the dividend. Clear. That you need only on the payment date. To whom you are going to pay.
Okay.
Yep. Next comes a property dividend. Sometimes what happens is you don't have liquid cash to pay dividend. Okay. You don't have cash in the bank, or you have cash in the bank and you don't want to give it as dividend. You need money. So what do? You decide to, you have, for example, you have piece of land you have. You can declare it as dividend. You have 10 properties. Out of this one property, you can declare as dividend.
So we will sell this property, and with the money we get, we will declare as dividend.
Maybe, for example, you four are the shareholders. I will write this piece of land on your four people's name. Got it. I will not sell. I don't take that time to do this. I just transfer this property to your name. So that is what the property dividend. It can be either property, it can be sometimes stock or any items you have, any goods. You can give it as dividend.
Increasing shares.
Not increasing shares. It's a dividend only. But what happens, rather than putting cash on the credit, you put property on the credit. Dividend account debtor to you put cash, right? Dividend payable account debtor to cash normally you put. Here you are paying in asset, for example, car. You are giving as car. For example, you are a car dealer and you don't have money to pay. You are giving car to every shareholders. So, but When you give dividend as kind, what you will record? There should be a monetary value should be recorded, right? So we will decide how to figure out. What you do is you first take this particular asset, what you're giving as dividend, and find out the fair value. Fair value means what is the market value of this body. For example, you are going to distribute cars as dividend because you have a lot of cars in your warehouse. So you took 10 cars and each car is 100,000 dirhams. It's a market value. So you record it as the property's value. Okay, maybe in the books of accounts, the book value, the car's value is only 80,000. Now, what you have to do? You have to increase the car value in the books. That's the first journal entry. Got it? So you will show a gain first. Then you will pay as a dividend. Got it? Now, so when an entity declares a dividend consisting of tangible properties, first the property is remeasured to fair value as of the date of declaration, and any gains or losses on the remeasurement is recognized in the statement of income. That means in the P&L you will show a gain or loss. So what happens? This remeasurement happens on which date? On the declaration date. When the board of directors declare the dividend, in the last example I said the accountants will pass a journal entry, return earnings account up to dividends payable. Now here the accountants have additional job to recognize a fair value also. So first he will recognize a fair value, then he will recognize the dividend entry. Clear? Now, second, the carrying amount of the retained earnings is decreased to the fair value of the property to be distributed. Then, third, the property is distributed as a dividend. Now, we will see the example, you will understand more. Sorry. On August 1st, a company's board of directors declares a property dividend. That means they are going to declare dividend as land to be distributed on December 1st to the holders of common stock. On August 1st, the carrying amount of the land to be distributed is 50,000, but its fair value is 80,000. So you should recognize a gain of 30,000. Your entry will be property account debtor to gain on gain on fair value of the property. So this 30,000 go to P&L, and from the P&L it goes to the return earnings. You're getting. So return earnings will show a higher profit, increase the return. Then it will decrease for the 80,000. Yeah. Now what happens? The land value 30,000 increases. Okay. And the property dividend payable will be 80,000, and gain on land measurement will be 30,000. Got it? You didn't understand. Okay. I'll just. Are you able to see the Excel sheet? Why don't?
No,
Not this one. So when you pass a journal entry for recording the gain, the entry will be property account debtor. Okay, 30,000 going to increase to gain on measurement. How much? 30,000. Okay. Now what happens? The books of accounts, your assets value was 50,000, right? Once you pass the journal entry, it will become 80,000 plus 30,000. Got it? And this 30,000, where it will hit? It will go to the P&L, right? And this 30,000 hits the balance sheet, right? Now, next what happens? you are going to declare the dividend. Now the assets value is now 80,000. So next entry will be a normal dividend entry. What is that? Return earnings amount of the 80,000. That is assets value, right? To asset, that means property, right? How much? 80,000. So once you pass this journal entry, it becomes 0. Your asset becomes 0. Okay.
Yeah, second one.
Second, just second. Return earnings. Taxes will become 0. It's the dividend entry. Ah. From here, your entry will become dividend payable account. Okay. And once you transfer the asset to the investor, your entry will be dividend payable account after 80,000 to property, right? Yeah, asset. So now the assets value will become 0. Get it? Okay. So this is done. Now comes the
Because how
whatever.
after a new one will decrease the value of assets.
Okay, if you want that example. Okay, let's discuss about that also. Okay, if for example, one doubt came, what if the assets value decreases when you do the fair value valuation? This could be more practical one, right? This normally happens. You have an asset, its value might go down. So you will record a loss. Okay, then the property value, for example, the property value was 80,000. Or okay, for example, put as same as 50,000. Assets value was 50,000. So now when you valued its current market value or fair value, okay, fair value is 30,000. Okay, fair value is 30,000. So now how much value decreased? 20,000. So you will have to debit the property, credit the property, and you show loss on revaluation 20,000. Okay, and you're going to pay this particular asset as dividend, right? Now after recording this journal entry, your assets value is now 30,000. Okay, now the value of the asset which you're going to declare or pay as dividend is 30,000, right? Okay, and you pay to the shareholders 30,000, the value. Now when you pass it on, you will cancel it out. Got it? Next. Then stock dividend and stock splits. Okay, stock dividends. Sometimes what happens, company won't have money, company won't have property also, but company want to issue make the shareholders happy. Even sometimes they have money, they have property, still they don't want to pay money as dividend. So what they do, they will issue some more shares to the shareholders. You have 10,000 shares, or you have 2 shares, or you have 1 share, we will give you 1 more share. So the shareholders feel happiness, even though nothing happens. It's the value of this old share became 50% less. That's the only thing happening. So that's called the stock dividend. You are paying stocks as dividend, but this is up to 20%. Okay, if you have 10 shares and I'm giving you 2 more shares as dividend, then it is called stock dividend. If you're having 10 shares and I'm giving you 5 more shares, then it's called stock split. Okay, so when you read this, you will get a better idea, and I will explain to you why there is a 20% and 25%. Now, a stock dividend involves no distribution of cash or other property. Stock dividends are accounted for as reclassification of different equity accounts, not as liabilities. Okay, the accounting for stock dividends depend on the percentage of new shares to be issued. Now, is small stock dividend, an issuance of shares less than 20% to 25% of the previously outstanding common shares should be recognized as stock dividend. Why it is said 20% and 25% means in some states of US they say 20%. Some says 22% because there is around 50-55 states all have different rules, right? And you know about US, right? In some states you are married, in some states you are not married, depends upon the law. So the same way, some states they have 20%, some they have 25%. That's it. We have given 20 and 25%. Okay. Then large stocks dividends, an issuance of more than 20% to 25% of the previously outstanding common shares should be recognized as stock split in the form of dividend. Okay. You are splitting the stock and giving as a dividend. Got it. Now, in both cases, you have a different treatment. Now, on 1st of May, a company's board of directors declared and paid a 10% stock dividend on the 45,000 shares of common shares outstanding, $1 par value. The stock was traded for $15 per share at the declaration date. That means the market value of the shares which is trading in the market is for $15 per share. Now, so how much shares we are going to declare? We already have 45,000 shares. We are going to declare 10% shares as dividend. So 4,500 shares we are going to issue. And what is the market rate? $15. So how much money we have to move from the retained earnings? That is 67,500. That is 4,500 shares into 15 market price. Clear. So 67,500. So 67,500, how we will record? From the common stock 4,500 and additional paid in capital 63,000. Clear? Got it? Your entry will be common stock 4,500, additional paid in capital 63,000 to return earnings 67,500. Understood the journal entry? Any doubts?
Sir, can you explain this one again?
Okay. The stock dividend, right? The
Yes,
whole
sir.
thing or the questions? It's just a question.
I didn't get the concept actually.
Okay. Now, for example, you have 45,000 shares in my company. Okay.
Okay.
And I want to keep you happy because I'm not paying you dividend in cash or in property. So what I say,
Okay.
I will give you 4,500 shares more.
Okay.
That means 10% of your current holdings.
Okay.
Okay. Now, if I'm giving you this 4,500 shares, you can sell it in the market, right? So the market value is $15.
It has a value. Okay.
Okay. So 67,500 values shares I'm giving you.
Okay.
So from where I will take this money? 67,500. I will take from the retained earnings.
Okay.
Okay. Not money, but I'm giving you as common shares 4,500 and additional paid in capital 63,000. Clear?
Okay.
Your journal entry. You have any doubt in the journal entry?
No. It's clear now.
Next.
Only the face value we will book into the common stock, and the
Yeah, only the face
difference
value.
of market value, it will go to the additional paid up capital, correct?
Yeah, the additional, the more than whatever you pay from the face value goes to the additional paid in capital.
Clear, sir. Okay. Thank you.
For a stock dividend that is accounted for as a stock split in the form of dividend, the par value of the additional shares is reclassified from the retained earnings to common stock. Okay. Here, for example, we assume that 40% is the stock split. The company is declaring 40% as dividend shares. If it is more than 20 or 25%, then it is a stock split, not a stock dividend. Even in the examination, they might give you question saying that 27% company is declaring as dividend. What it is, whether it is a stock dividend or a stock split. Clear? Now, if it is more than 20 or 25%, it's a stock split. Now, what if this is a scenario? Then it's a stock split. We don't take the market value. Okay, we just recognize the number of shares. Got it? Return earnings, from return earnings, we will take 18,000 and transfer to common stock. Why we do this? Why? Because here, in the first case, what happens is it doesn't make much impact in your stock market prices or stock market. Okay. Or your holdings, only 10 or 20%. So in that case, even if you sell these additional shares in the market, it is not going to impact the shares much higher way. Now, in this case, what happens? You had 45,000 shares. Now it became 40. How much? 45 plus 18, around 63. Right, 63,000 shares is there. So whoever had 45,000 into 15 now have 63,000 into 15. So the market value will go very high. So what happens in the automatically in the market, if you are doing a stock split, the market value crashes. It will reduces and comes to price of this whatever it was before. Okay, got it. Usually, when the company declares like this, for example, once I had some shares of some company, longer, 20 years back or something. So at that time, I had only one share of that particular company because it was a very costly share. Like for example, 3,000 dirhams was one share's value. So this share, the company declared a stock dividend, stock split. That what happened? They said whoever having one shares will get 10 shares. Then I should be rich, right? I had one share for 3,000. Now I have 10 shares. So it becomes 30,000, right? So what the company also did, the share per value per share value became 300. Okay, then why company does large stock dividend or stock split? Because some shares you might know, like Google or those things, it is 10,000, 15,000, 20,000 dirhams for one share. So normal people can't afford to buy one share. To make more affordable and more volatile the shares, they do these things. So any common man can buy the shares. Got it?
Yeah, but if they do a stock split, the price of the share will be very low.
Will go down. Yeah.
Then how will they increase it?
No, it will increase according to the market requirement. Like, see, before.
But it will affect the net worth of the company.
No, it will
If
not
the-
affect the net worth. Nothing will affect.
If the company share price is going down.
No, the total value of the balance sheet is same, right? So what you do, you took 18,000 from this pocket and put it in this pocket. From the return earnings, you transfer to the common stock. That's it. Nothing is happening. The total book value is same. If you are declaring a dividend as cash, your money goes outside. Then your book value comes down. Or if you are paying as a dividend as a property, also your property is going outside. So your book value comes down. Here you are keeping your book value intact. Nothing is happening to your book value. Got it?
Yeah.
Yeah. Then comes the stock split. The stock split is a real scenario where we splitting the stocks into number of like 1 into 10 or 1 into 100. That is stock split. Okay. So stock split are issues of shares that do not affect any aggregate par value of shares issued and outstanding or total equity. Stock split reduces the par value of each stock and increases the number of shares outstanding. Okay, no entry is made and no transfer from retained earnings occurs because you had 10 shares, now you have 100 shares. That's it. There is no value differences happening. This is the third scenario.
Yeah.
This is the third scenario. Yeah.
This 10 shares into 100, but the amount is.
Amount is same. Okay. Now, because for example, you had last my example is you had 1 shares for 3,000. Now you have 10 shares, but the total value of your investment is only 3,000. Per share value is now 300. Got it. Now, so no entry is made and no transfer from retained earnings account occurs. Primary purpose of a stock split is to improve the stock's marketability and by reducing its market price and proportionately increasing the number of shares outstanding. The table summarizes the whole impact. Now, small stock dividends and large stock dividends, par value per share is not affected. Okay, stock split, what happens is the par value per share decreases. This is a summary of what we all discussed. Okay, next, limitations of the statement of changes in equity. The financial statement report accurate basis results for the period. The company may recognize revenue or expense and report net income before any cash was actually received or paid. The data for retained earnings is not sufficient for assessing the amount actually available to be reinvested in the company or to pay dividend or debt. The statement of changes in equity illustrate a company's equity based on specific time period, which means equity may vary significantly a few days before or after publication of the statement. This is the same thing we said as a limitation for balance sheet also. Okay. Next comes the statement of cash flow. As we said in the initial of the class, when you say about a financial statement, a financial statement means it is balance sheet, P&L, and cash flow. With these three only you can understand about a company. Now comes the main part of the cash flow, where cash flow gives you idea where does your money went. You might have profit and you don't know where it is gone. You can't see in your cash. For example, you made a 1 million profit. In your cash, you have only 5,000 dirhams, or maybe you have a negative cash. So you need to know where the cash went. To figure out that, we prepare the cash flow statement. So cash flow statement is divided into 3 main areas. One is net cash provided or used in the operating activities, cash flow from the investing activities, and cash flow from the financing activities. And preparing the cash flow statement, we have 2 methods. One is direct method and one is indirect method. So indirect method is the one popular one, which we use because if you are using a direct method statement, still you have to prepare the reconciliation between the profit and the cash flow. That's what we do in the indirect method. So to avoid the double work, people usually do the indirect method first. That is what we reconcile the profit. For example, as I said, we had a profit of 1 million, but in the cash flow we have only 5,000 cash. So where did the money went? To figure out that, we draw a cash flow statement and we will see where the money went and we reaches the cash balance. Okay, now the primary purpose of the statement of cash flow is to provide relevant information about the cash receipts and cash payments of an entity during the period. To prepare a direct method cash flow statement, it is very easy. Take the cash book, take the bank book, combine all together, take the debits and credits, you get the money where it went. Okay, it's very easy. But for the indirect method, you have to figure out all these areas. Okay. Now, to achieve this purpose, the statement should provide information about cash inflows and outflows from operating activities, investing, and financing activities. This is the accepted order of presentation. So, what you do? Operating, investing, then financing activities. The statement of cash flow should help users assess the entity's ability to generate positive future cash flows, liquidities, its ability to meet obligations, and its financial flexibility. Now, the statement of cash flow explains the change in cash and cash equivalents during the period. It reconciles the period's beginning balance of cash and cash equivalents with the ending balance. So in the beginning of the year, how much money we had, ending of the year, how much money we have. So in between, what happened? Where did the money went? Whether we invested or we took finance or the operation was on a loss or not. Correct? No. So this is how a typical cash flow looks. Okay. Entity A statement of cash flow for the year ended December 31st. Net cash provided by or used in operating activities. Cash provided by means it will be positive, used in means it will be negative. Okay, that means outflow is more. Okay, when it's outflow, it will be negative. Clear. Next, cash provided by or used in investing activities, then provided or used in financing activities, you get the net increase or decreases in the cash and cash equivalents. That is 24,000.
There are specific, so specific activities, for example, for operating specific details, which some of them increase and some of them decrease.
Yeah.
Each one of them.
Yes, we will see in detail inside what all comes. Like working capital increase or decrease in the working capital, changes in the working capital basically. We bring that difference also inside. This is just a summary here. Then, so we have the net inflow. Then we will add our opening cash balance. Then we should arrive the ending cash balance. Clear? So basically, whether you do a direct method or an indirect method, the only difference you will see in the operating activities. So operating, investing activities and financing activities, you will do the same calculation in the both places. But in the operating activities for direct and indirect, you have different methods. Clear? Now, so operating activities are all transactions and other events that are not financing or investing activities. That means your core business activities. Cash flows from operating activities are primarily derived from the principal revenue producing activities of the entity. They generally result from transactions and other events that enter into the determination of net income. Okay. Now, the following are the examples of cash inflows from operating activities. One is cash received from the sale of goods and services, including collections of accounts receivable, and cash received from royalties, fees, commissions, trading debt securities, and other revenues. Then cash received in form of interest or dividends. It all comes under the operating activities cash inflow. Then cash outflows are cash payments to suppliers or for goods and services, cash payment to employees, cash payment to government taxes, duties, fines, and other fees and penalties, and payment of interest on debt. Got it? Now, what all things comes under investing activities? Cash flow from investing activities represent the extent to which expenditures have been made for resources intended to generate future income and cash flows. So that means we have invested in a property or machine, or we have a investment in a share. This all comes under the investing activities. Now, the following are the examples of cash flow, cash outflows and inflows from investing activities. One, cash payment to acquire property, plant and equipment, intangible assets, and other long-lived assets. If you are paying some money to get property, plant, or equipment, or any intangible assets, it is a cash outflow in investing activity. Second thing, this is actually two sentences. Okay, cash payments or cash receipts from sale of property, plant and equipment, intangible assets, and other long-lived assets. Okay, this is actually two sentences. Got it. When you read as cash receipt, this is a cash inflow. Okay. Cash inflow. Got it. Next, cash payment to acquire equity and debt instruments or other entities for investing purposes. For investing purposes, you are buying some other company's shares or securities, then it will fall under investing activity. Got it? Next, cash advances and loans made to other parties. and cash received from repayment of advances and loans made to other parties. For example, employee taking a loan, or we are borrowing some money to some other company. This all comes under the investing activities. Comes the financing activities. Cash flow from financing activities generally involve the cash effects of transactions and other events that related to the issuance, settlement, or reacquisition of the entity's debt and equity instruments. For example, if you are issuing our shares, or if you are buying back our shares, or buying back our debentures, bonds, it all comes under the financing. Or even if you are taking a loan, bank loan also, it comes under the financing activity. Yeah, and your repayment of the bank loan comes under the financing activity. So the following are the examples of cash inflows from financing activities. Cash proceeds from issuing shares and other equity instruments. Then cash proceeds from issuing loans, notes, bonds, and other short-term and long-term borrowings. Then the following are the examples of cash outflows from financing activities. There is cash repayment of amounts borrowed, payment of cash dividends, cash payments to acquire or redeem the entity's own shares. That means when you buy back treasury stocks, those entry will come under the financing activity. Cash payment by a lessee for a reduction of the outstanding liability relating to a finance lease. Okay. So when you're preparing a cash flow statement, you have to do a few disclosures, because there may be some transactions happening in your books which is not relating to cash. Okay. So information about all non-cash investing and financing activities, that is investing and financing activities that affect recognized assets or liabilities, but not cash flows, must be disclosed in the notes. Okay. The following are the examples of non-cash investing and financing activities, that is conversion of debt to equity. I think we have discussed, right? Convertible debentures. Debentures which can be converted to shares. Okay, there are some bonds, or do you know what is a bond or debenture? Any idea? Yeah, bond.
Is a governmental issue.
Yeah, that is governmental bonds. Like for example, if a company needs some money, what are the options? First one is either go and take a bank loan. If you're taking a bank loan, the problem is you have to pay interest. Even if you don't have a profit also, you have to pay interest. Second option, you can take money from the public. You can borrow money from public. They are not becoming your shareholders. Okay. So for that, we issue a debt certificate. That debt certificate is called debentures or bonds. Okay, there are different kind of period bonds. We have term bonds, a lot of serial bonds, a lot of different kind of debentures bonds are there. Next, in this bank loan also, no one else is becoming your shareholder. Debentures also, no one is becoming your shareholder. But if you are issuing preference shares or equity shares, they are becoming your owners of your company. For example, you don't want to sacrifice your ownership, then you will issue bonds so that you get money. Second thing, when you issue a bond, you might give some facility to these bondholders. If you want, you can convert this bond to shares or equities in the future. What happens is, if I brought some debentures from your company, later on with this facility, convertible debentures I brought, I come and tell you, okay, I want to convert this to shares. Now you will convert it into shares. No cash is involved. No one is knowing what is happening. But here, you have to show in your disclosures, in the notes, you have to mention this much number of bonds has been converted to equity shares. Clear. Next, acquisition of assets either by assuming directly related liabilities or by a lessee's recognition of a finance or operating lease. For example, you brought a car. If you're getting a car on rent, there is no record, right? You just show it as your expense. But if you are leasing an asset, okay, you have to show under investing and financing activities, like in investing activity, basically. Yeah, investing activity. Why? Because you are getting a facility, you're using it. Okay, so and you have an asset in your books, and it net off Because when you leases an asset, you will have right to use of asset and lease liability. The net effect is 0 and there is no cash transaction happening. Got it? So it will not reflect in your cash flow. To show this to the public, you have to show in your disclosures and in the bonds about that transaction. Then exchange of a non-cash assets or liability for another. You had a loan, okay, with the bank for 10 million. Now you have a accounts receivable for 10 million. You said to the bank, okay, take that money, settle off. You go to the receivables and collect the money, settle off. This will not come in your cash flow statement because so you have to show in your notes to accounts. Clear? All good, Varun?
Yeah, good.
Now introducing the indirect method of presentation of operating cash flow. Under the indirect method, also called as the reconciliation method, the net cash flow from operating activities is determined by adjusting the net income of a business for the effect of the following. So in the P&L, when you derive the net profit, okay, this net profit is not a real net profit, right? It's not the cash profit, you would say. In the profit, you might made a profit of 100,000 and you had a depreciation of 30,000. You reduce the 30,000. Now your net profit is only 70,000. Actually, is it 70,000 your real cash profit? No, actually it's 100,000, right? This 30,000 is a fictitious amount. So those amounts you will add back to figure out what is your real cash profit. Got it? So here, what all items we will add back is the non-cash revenue and expenses that were included in the net income. In the net income, what all in the P&L, what are the items which is a non-cash item which we record? Provision for bad debt. Just a provision, right? Provision for uncollected, you mean? Okay. Then what else? Impairment losses, depreciation, those things we have to add back to your profit. Those expenses and any unearned income is there, you have to reduce also. So that's what we do here. So such as depreciation and amortization expense, impairment losses, undistributed earnings of equity method investments, and amortization of discount and premium on bonds. Okay. Out of these items which are I mentioned, any item which is new for you, let me know. Those wordings, any wordings is new for you. Depreciation, you all know. Amortization, you all know. Amortization is the pet name of depreciation for intangible assets, right? Okay. Next comes the impairment losses. Idea what it is? No. In simple terms, even after we do depreciation, we get a figure, right? Carrying amount. What we do for every asset, if there is a scenario that you think, or there's a situation that your assets will not get the market value as what you show in your books, then you do a market analysis. You do the fair value check for these assets. And if the fair value is lesser than your carrying amount, you will record a loss. That loss is called the impairment loss in simple terms. Next comes the undistributed earnings of equity method investment. What is that?
Which one, sorry?
Undistributed earnings of equity method investments. Any idea what it is? Varun?
Undistributed earnings, it's
No idea.
rated earnings. Same thing.
Okay. I'll tell you. Why this is important because when you get a cash flow question, you need to know these things. Okay. Anybody working in a parent company or a holding company? Any of your companies have subsidiaries? Your company has. Okay. Okay, for example, if I am a parent company, that means I am an investment company. I don't do business. I invest in companies. Okay. So what happens? You four are my subsidiary companies. Then when I prepare my P&L and balance sheet, what I have to do? I have to consolidate your statements. If I am holding more than 50% voting rights or power in your company, maybe it's 100% in your company. Everyone's company, I'm holding 100%. Then what I do, I club all these financial statement and show it as my financial statement. So that's the consolidation. Even if I'm holding 50% or 51% also, your company is my company. Maybe 49% is holding by somebody else, but still I will show in my books of accounts as my company. 100% assets, your 100% assets and your 100% liability, I will show in my books of accounts. So what about the 49%? I will show it as non-controlling interest. Okay, it is a negative reduction mark from your total points or total value. Clear? That's a non-controlling interest. That's for the 50 to 100% holding subsidiaries. And if you're having shares from 20 to 50% in a company, okay, if you're having less than 20% shares in another company, you can't do consolidation because you don't have any power there, right? Because it's not your company. 80% is holding by somebody else. They are going to take decision. So it is in those shares investment, we take the shares value as market value or fair value. Whatever the market value, I will take it as a and they show in the balance sheet as investment. Now, I'm holding 20 to 50% shares in your company. And I have an option. We have two options. If you are holding from 20 to 50% holding, there's a method, either equity method of accounting or fair value method. Fair value method means, for example, I'm having 30% shares in your company. Then what is the share value multiplied by the market value of the shares? I will show it as investment in my books. Now, if I'm choosing equity method of investment, then what I will do is 30% of whatever profit you make this year. For example, you made a profit of 100,000. Now, in my P&L, I will show this 30,000 as profit because I am holding 30% shares in your company and I am following equity method of accounting. Now, I will show this 30,000 in my books of accounts in the P&L. It will not go to the balance sheet. It will go to the P&L as undistributed earnings of equity method investment because I am investing in your company, but I haven't received those money. I know you made 100,000 profit. Out of this 30,000 is my money. Maybe you are declaring only out of 100,000, you are declaring 10,000 as dividend. Then I will get only 3,000 as dividend. But got it. So this 3,000 when I get, it goes to the balance sheet and reduced from the investment. Got it. So whatever the profit unearned equity method investment, it goes to the investment and adds up there. Okay. For example, I invested 30,000 and this 30,000 profit also go and add there. It becomes 60,000 in my balance sheet. And after 1 year, you gave me a dividend of 3,000 dirhams. So I will show it as receipt and reduce from the investment. Clear? Got it? So that's what all about undistributed earnings of equity method investments. Any doubt, Varun?
No, no.
Okay. Then comes the amortization of discount and premium on bonds. So when you issue bonds or debentures, what happens? You have to record under interest yield method. We call it as interest yield method. We compare your market interest rate, just like for the leases. You record amortization of leases, right? You record. It is a difference between the interest we pay and the interest we calculated. The same way we do for the bonds also. Clear? So those amount is not actually the real expenses. Maybe our interest is only 10,000, but we are recording 15,000 as our amortization expense. So only 10,000 we will record as expenses. Clear? Got it? No. Then items included in the net income whose cash effects relating to investing or financing cash flows. For example, gain or loss of sale of property and equipment. When you sell a property, you get a gain. Where does you show that? In your P&L. So that profit should be shown under where? In the financing or investing activity. So that amount you have to remove from your profit and take it to the investing activity or financing activity. Clear? Then sale of gain or loss from the sale of property or equipment goes to the investing activities, and gain or loss on the extinguishment of debt goes to the financing activities. Clear? Next, all deferrals of past operating cash flows, such as changes during the period in inventory and deferred income, this all we will adjust. Then all accruals of expected future operating cash flows, such as changes during the period in accounts receivables and accounts payable. This will also be adjusted from the P&L. Clear? Yeah. Next thing. This is a small recap kind of stuff here. The following rules will help reconcile net income to net cash flow from the operating activities under indirect method. Now, for example, your current operating liabilities increased. What does it mean? Your accounts payable increased. Last year it was 50,000. Now it is 100,000. That means, okay, for example, what? Okay. Yeah.
This is when I have more payable for operating activities. This will increase expenses for specific time, but in the future, this will increase the income.
Not that on that end. Here it's all about money. It's what is, for example, last year you had 50,000 as accounts payable. This year you had 100,000. That means you didn't pay additional 50,000, right? You have that cash. It is a concept. Got it? That's why your accounts payable increase. That means that money you will add to your net income. For example, I will give you the best example for accrued salaries. Just like accrued salaries, you will add the excess amount to the net income. Or any kind of payments, suppliers payment you haven't paid, that means you're holding that money with you. So you will add back. Clear? Next, decrease in current operating assets. Operating asset decrease. That means your accounts receivable decrease. Last year accounts receivable was 75,000. Now it is only 50,000. That means no, you collected money. Accounts, not accounts payable, accounts receivable. Sorry, accounts receivable. It was 75,000 last year. Now it is only 50,000. You collected money, so you will add that money to the net income. Same way for the increase in accounts current asset, operating current asset. That means you will subtract from the net income. You will reduce, and for decrease in the current operating liabilities, you will subtract. Then comes the non-cash losses and expenditures incurred in the net income. You will add to the net income. Okay, like depreciation, provision for bad debts, those things. Then losses and expenses whose cash effects are relating to investing or financing activities, you will add to the net income. Then non-cash gains and revenues included in the net income, you will minus, and gains and revenues which effects should go to the investing and financing activity also, you will reduce from the net income. Will you stick till 9:30? Yeah. Then we will solve this question. It's a long, full question for cash flow. If you don't have time, then we will do next class. What do you all say? Varun, what do you say? Next class?
It's okay because I know that it's takes so much time.
Yeah, it takes time. That's why I push to next class. Okay, next class, then we will discuss the first. Okay. Please revise and come back. We might need
Sure.
those knowledge. Okay. Yeah. Thank you.
Thank you. Thank you, sir.